Hey traders, welcome back to your fifth lesson in this introductory course. In this lesson, we'll be going over the types of analysis and an introduction to technical analysis as well as Japanese candlesticks. So let's get right into it. So, in analyzing stocks, there are three main types of analysis: technical, fundamental, and sentimental. Let's go through them. So first off, we have technical analysis. This is the main tool traders use to analyze price movement. It's defined as the method of evaluating securities by analyzing statistical trends in the stock's price and volume over time. It focuses on patterns, trends, price movement, and volume to try to determine the future price of an asset. And then we have fundamental analysis. This involves analyzing financial statements, economic indicators, interest rates, news and events, and qualitative information to determine the real worth of a security, a stock, a whole sector, or even a market. This is something that you'll often hear on the television, whether you're watching CNBC, Bloomberg, or otherwise. They will be talking about these macroeconomic data, and that involves a lot of fundamental data, which in turn is used for fundamental analysis. Then we have sentimental analysis. This requires market experience as it involves judging the tone of the market through the study of crowd psychology. It involves analyzing the general attitude of traders, which shapes the overall market mood and is within a specific time frame. So traders will use all three types of analysis, but will likely rely more heavily on the technical side of things compared to sentimental and fundamental. For this reason, we're going to focus primarily on technical analysis. A key component of technical analysis is Japanese candlesticks. Let's talk about those. So, traders use Japanese candlesticks, or JCS for short, to visualize the movement of the market. This movement is commonly referred to as price action, and Japanese candlesticks are very effective in quickly understanding this. So each Japanese candlestick has a distinctive visual. It can represent any time frame and is a carrier of 6 price data features. The first 4 are visual representations, while the last 2 are embedded within the candle. So first we have open price. This is where the candle price data has begun recording. Then we have the close price. This is where price data has finished being recorded at the end of the chosen time frame. Then we have the high price, which is the highest recorded price within the time frame that the candle represents, and then the low price, which is the lowest recorded price within the time frame the candle represents. And then we have volume. This is data that is embedded into the candle, as well as the time frame, which is just the time at which it is measuring. So if we look to our right, we'll see 2 examples. One that says a bullish candle and one that says a bearish candle, white and black. So the colors of the Japanese candlesticks can be arbitrarily chosen by traders. However, most of the time a green or white candle will represent a bullish candle, or that means a candle where the opening price is below the close price, and a red candle or black candle represent a bearish candle where the open price is higher than the closing price. If you look to the top right of this slide, you will see a visual representation of both, highlighting the various visual aspects of a Japanese candlestick: the body, the shadow or tails of the candle, the open, the close, the high point, and the low point. Let's move on. So most, if not all, the candles have unique and distinctive features versus past candles. A visualization of a series of candles trading sideways is called price consolidation, and visualization of candles trading higher or lower is called price trend. So let's look at a chart of Amazon. To the right, the candles are in a small range and seem to be moving mostly sideways from the 22nd of November to the 12th of December 2023. And then the price breaks higher and the candles become larger as we start to continue trend. In the white box, you can see that consolidation. and then we can see the trend continue once price moves outside of it. Another very important feature of visualizing JCs is the ability to detect support and resistance levels, a feature of extreme importance to professional traders, and it's something that we'll talk about more as the lessons continue. So now let's look at distinct Japanese candlesticks, and let's take a look at the Amazon daily chart, because this is a great example as it contains all the formations we need to discuss in this lesson. Let's start with the doji. So doji, what is a doji? Doji JCs represent candles where the opening price and closing price are virtually the same. In Japanese, the term means blunder, and in trading language, this can often be early signs of a reversal. A series of consecutive doji candles represents a sideways move in the price, and that can be translated again into price consolidation, a positive term, or price choppiness, a negative term. Most of the time, a sideways move in price will be represented by some form of a doji candle. Usually, professional traders stay away from trading a series of doji candles, in other words, sideways or choppy action. There are very distinctive price patterns based on doji candles, and those will be discussed later on as we talk about price patterns. But for now, let's take a look at the chart. If you look in that white box we've highlighted, you can see a series of candlesticks which show us several formations. Let's run through the different dojis first. You can see a long-legged doji, a gravestone doji, and a dragonfly doji. Compare the examples on the left with the chart above. If you look to the left below the laptop, you can see signs of a spinning top, an umbrella, a long white and black line, long-legged doji, gravestone doji, and dragonfly doji. If you look closely, you can see both a long-legged and dragonfly doji in the white box that we've highlighted. They often give that pin-like appearance. Other formations you can see are the spinning top, the umbrella, the long and white black line. In this case, it would be green and red, which replace white and black. And as we said earlier, green representing bullish and red representing bearish. So speaking about other formations, let's now take a look at the bullish hammer. So another distinct candlestick is the hammer JC. The hammer candle can signal a bullish change in the trend. If the candle represents a very large handle and has a small head, hence the term hammer, then the signal represented by the candle is more distinctive, and more traders are likely to react to it. It's also important to observe the accompanying volume. Is the volume increasing or not in response to the hammer candle? Remember, volume depicts the amount of traders getting involved. So if you have a candle with very large volume, that means a lot of transactions have occurred in that candle, and as such gives you added confirmation that more things are happening and more traders are paying attention to it. So if we look to the left, in the chart above, we've highlighted examples of a bullish hammer with orange arrows. To the right, you can see a close-up of the example of another form of bullish candle, the hangman. So if you look to the right, you can see the snapshot of the hammer, the hanging man, the inverted hammer, and the shooting star. So while a hammer or hanging man can often be an early signal of bullish changes, it may not always be the case. Scan through this Amazon daily chart above to see where you can spot these formations. So now let's take a look at the bearish hammer. The bearish hammer can signal a bearish change in trend. If the candle represents a very large handle and a small head, then the signal represented by the candle is more distinctive and more traders are likely to react to it. Again, it's important to observe the accompanying volume and ask yourself, is the volume increasing or not in response to the bearish inverted hammer candle? So let's take a look at the right. You can see a close-up screenshot of what a bearish inverted hammer looks like. And then if we take a look at the laptop, and you can see that yellow box on the chart. as we've highlighted the inverted hammer, and to the right you can see a bullish shooting star. Let's now take a look at bullish engulfing candlesticks. So the engulfing candlestick, as it somewhat infers in the name, it involves a candle that is engulfing something. When we talk about engulfing, we talk about bullish and bearish engulfing candles. Let's start with the bullish one. So a bullish engulfing candlestick consists of a large body bullish candlestick that engulfs a smaller bearish candle before it. The pattern can be important because it shows that buyers have overtaken sellers and are pushing the price higher. The chart shows us an excellent representation of this if we look to the left in that yellow box, where a small red daily candle is followed by a huge green candle. You can see it engulf and fully overtake that small candle with a huge green candle. So the last candlestick we want to cover is bearish engulfing. So a bearish engulfing candle consists of a large body down or bearish candlestick that engulfs a previous smaller bullish candle before it. The pattern can be important because it shows sellers have overtaken the buyers and are pushing price lower. Again, the chart to the left shows us an excellent representation of this in the orange box, where the subsequent red day fully engulfs the previous green day. So if we're looking at this Amazon daily chart, in that orange box you can see that green day and that full red day that engulfs it and goes even further, showing that sellers have overtaken the buyers and are pushing price lower. And our final topic of this lesson is time frames. We'll be speaking a lot about this through the course, and as mentioned earlier, a data point of the Japanese candle is the time frame of data which it represents. Time frame simply refers to the unit of time measured by the candlestick. You would have heard me before refer to the Amazon chart as a daily chart. This is the time frame of it, and these can range from 1 minute to 1 month. For example, a 5-minute chart will display 5-minute candlesticks, each opened and closed during a 5-minute period, as opposed to a daily chart which will show candlesticks that have captured trading data from an entire trading day. The larger the time frame, the more data captured. As such, traders will use larger time frames to get more of a bird's eye view of what is happening in the market. To select a time frame on your chart, it's as easy as using the time frame option in the toolbar of your chart, as highlighted in our screenshot to the left. And that's it, traders. Thanks for tuning in. Looking forward to seeing you in the next lesson. Take care. Bye for now. See you soon.